Every year, tens of thousands of investors travel to Omaha, Nebraska to sit in an arena and listen to Warren Buffett talk about investing. What most of them do not realize is that some of the most useful things Buffett has ever said were not about his wins. They were about the investments he wishes he could erase from the record entirely, the ones he called gruesome, the ones he said deserve a spot in the Guinness Book of World Records, the one he admitted was driven not by analysis, but by spite. Today, Warren Buffett tells those stories himself, the stocks he bought that he wishes nobody knew about, and what those mistakes taught him that no success ever could. Stay with me. This is the version of Warren Buffett that Wall Street never puts on a poster.
Every year at the Berkshire annual meeting, someone asks me about my best investments. Coca-Cola, American Express, Apple, See's Candies, the hits, the ones that compounded into fortunes and validated the framework and confirmed the thesis. Nobody ever asked me about the shoes, and honestly, I understand why. The shoes are not a comfortable story. They are not the kind of story that fits neatly into a book about investment principles or gets quoted in a commencement address or inspires a young investor to believe that careful analysis and patient holding and genuine understanding of a business will reliably produce extraordinary outcomes. The shoes are the story of how the greatest investor in the world, by whatever metric you choose to apply, looked at a business, thought he understood it completely, and turned out to be wrong in a way that cost his shareholders somewhere between $5 billion and $14 billion, depending on which year you do the calculation. I want to tell you about the shoes, and then I want to tell you about something even worse than the shoes, because the shoes, as bad as they were not the dumbest thing I ever did with money. The dumbest thing I ever did with money was buy the company that is now worth nearly $1 trillion and that bears my name. Let me start there, with the origin of everything, and with the specific piece of information about how Berkshire Hathaway came to be that I genuinely wish I could remove from the historical record. The dumbest stock I ever bought, and I named my empire after it. Imagine that, 1962. I am 32 years old, sharp, confident, running a successful investment partnership out of Omaha, and I am looking at a failing New England textile mill called Berkshire Hathaway that is slowly being killed by cheaper foreign competition. Now, here's the thing that most people who know this story miss. I knew it was failing. I knew the textile business was a terrible business, capital intensive, commoditized, no pricing power, no moat, the kind of business that Charlie Munger would later describe with language I will not repeat here, but that I found instructive. I bought it anyway, not because I thought the business could be saved, because the assets, the looms and the inventory and the real estate were worth more than the stock price implied. A cigar butt, one last puff of value, buy it cheap enough, and even a dying business can generate a return. That part was correct. The cigar butt strategy worked on Berkshire Hathaway, the stock. The problem was what happened next. The mill was run by a man named Seabury Stanton. In 1964, he made me a verbal offer to buy my shares at $11.50 each. I agreed. When the offer came in writing, it was $11.37.5, 12.5 cents difference on a large position, but still 12.5 cents per share. I was furious, not rationally furious, emotionally furious. The specific kind of fury that does not respond to logic and that produces decisions that logic would never endorse. I did not take the offer. I went out and bought more shares. I accumulated enough to take control of the company. I fired Seabury Stanton. And then I sat with a majority stake in a dying textile business that I had purchased out of spite rather than strategy. I spent the next 20 years trying to redirect Berkshire's capital into better businesses while the textile operations slowly bled cash. The mills eventually closed. 1,600 workers in a small Massachusetts town lost jobs they could not replace at their age. I lost years of compounding in a capital-intensive loser because a man offered me 12.5 cents less than he promised. I have estimated the cost of that emotional decision at approximately $200 billion in foregone value. $200 billion. Because the capital that went into Berkshire Hathaway textile operations and the compounding years lost while I managed the transition would have gone into businesses that actually worked if I had never let Seabury Stanton make me angry. The lesson is one I have repeated so many times it has become almost invisible from repetition. Never make an investment decision while you are angry. Never let an emotion that has nothing to do with the business drive a decision about the business. The market does not care that you are furious. It does not reward spite. It does not punish the person who made you angry. It just records what you did and prices it accordingly. I knew that rule before 1964. I broke it anyway, and I named my company after the mistake to make sure I never forgot it. The most gruesome deal in history, and I used my own stock to pay for it. 1993. I am 63 years old. I have been investing for 50 years. I have developed and refined and tested and stress tested an investment philosophy that has produced one of the greatest compounding records in financial history. And I am about to buy a shoe company, Dexter Shoe Company, based in Dexter, Maine, making American shoes, good quality, loyal customers, long profitable history, terrific management, the kind of business that looked from the outside like exactly what I had spent 50 years learning to identify. Dexter is the worst deal that I've made. As a financial disaster, it deserves a spot in the Guinness Book of World Records. I wrote that in the 2014 shareholder letter, and I want to explain exactly why. Not just that the shoe business failed, the arithmetic of why it failed in a way that compounded my mistake into something that still keeps me up at night. The business was worth nothing. I had assessed Dexter as having a durable competitive advantage. Within a few years of my purchase, that competitive advantage had been destroyed by one thing I had not properly weighted in my analysis: foreign competition. By 1999, 93% of the shoes purchased in the United States were made outside the country. Cheap imports from China and elsewhere dismantled the entire domestic shoe manufacturing industry in less time than it takes most businesses to execute a 5-year plan. Dexter went to zero. The entire investment was lost. 1,600 workers in a small Maine town lost their livelihoods. People passed the point in their lives where they could learn another trade. I have thought about those workers many times since, not because the financial loss destroyed Berkshire. It did not. Because the human cost of a wrong business decision is not always contained to the people who made it. But here is where the story gets genuinely horrible. And here is the part I would most like to remove from the record. I paid for Dexter Shoe with Berkshire Hathaway stock, $433 million worth of Berkshire stock. At 1993 prices, that was approximately 25,000 Class A shares of Berkshire Hathaway. Today, a single Class A share of Berkshire trades above $780,000. 25,000 shares at current prices is approximately $19.5 billion. I gave away $19.5 billion in Berkshire stock to buy a shoe company that went to zero, not just the $433 million I paid, the full compounded value of those shares over the 30 years since the purchase. Because the sellers of Dexter Shoe received Berkshire stock in 1993, they held it, they collected the compounding, while Berkshire got a business that was worth nothing within 5 years. Charlie Munger calls it the double whammy. You lose what you paid, and you lose the compounding on what you paid, both simultaneously, forever. I knew never to pay for acquisitions with undervalued stock. I had said it publicly, I had written it, I believed it. And then I did it anyway because the deal felt right, and the business looked right, and the management seemed right, and I let that cascade of rightness override the single most important rule I had established for exactly this kind of transaction. The rules exist for the moments when everything feels right, because those are precisely the moments when the thing you are missing is most likely to be invisible. I am embarrassed to tell you about Tesco, not because the loss was larger than Dexter. It was not. Not because the mistake was driven by ego the way Berkshire was. It was not. I am embarrassed because the mistake was so simple, so clearly avoidable, so entirely a product of the one thing I had told investors for decades they must never do when a position is going wrong: dawdling. Tesco is Britain's largest supermarket chain. I began buying shares in 2006. By 2012, Berkshire owned 415 million shares worth approximately $2.5 billion. I liked the business, dominant market position, 30% grocery market share in the UK. The kind of company that sells things people need regardless of the economic environment. Then things started to go wrong, slowly at first. Management decisions I was not comfortable with, strategic choices that contradicted what had made Tesco dominant. Margin pressure from discounters gaining share. I started to feel uneasy. I sold a small portion of the position, made $43 million on the shares I sold, and then I held the rest, not because I had changed my mind about the concerns, because selling a large position takes time and effort and requires making a decision I was not yet fully ready to make. An attentive investor would have sold everything when the concerns first emerged. I am not always an attentive investor. In 2014, Tesco revealed that it overstated its profits by 400 million pounds. The shares collapsed 49% in a single year. By the time I had finished selling, Berkshire had taken a $444 million after-tax loss on a position I had been uncomfortable with for months before the accounting fraud was revealed. The fraud did not cause the loss. My dawdling caused the loss. The fraud merely confirmed that my discomfort had been justified all along, and that I should have acted on it months earlier, when acting would have been profitable rather than painful. This is the mistake that I think most individual investors make more often than any other. Not buying the wrong thing, holding the wrong thing past the point where the evidence says to leave, because selling means admitting you were wrong, because holding lets you avoid making the decision for one more day, because the position is already down, and selling at a loss feels worse than continuing to hope it recovers. Hope is a terrible holding strategy. I know this. I have written about it. I have said it in shareholder letters. And I sat in a $444 million loss anyway because I dawdled. The one that haunts me most, and it was not a bad investment. I want to tell you about the mistake that I think about more than Dexter, more than Tesco, more than the emotional purchase of a dying textile mill. It is not a bad investment at all. It is a good investment that I made too small. In the early 1990s, Berkshire held a position in Fannie Mae. I thought the business was excellent. The thesis was sound. The position was performing. And then the stock started moving up, getting more expensive, and I stopped buying, not because my view of the business had changed, because the price had risen past the level where I had established my initial position, and buying more felt like chasing rather than investing. I had the conviction, but not the follow-through. I stopped at a fraction of the position I should have built. Both of those decisions cost Berkshire approximately $10 billion each in foregone profit. Geico, a company I love, was one of Google's largest early advertising customers. I watched Google's advertising model work through the lens of what it was doing for Geico's customer acquisition costs. I understood what I was seeing. I recognized the moat, a natural monopoly on search advertising with virtually no incremental cost to scale. Every business principle I had spent 50 years developing pointed at Google as exactly the kind of company I should own. I did not buy it. I watched it from a front row seat through Geico's own advertising budget, and I convinced myself that technology companies were too hard for me to value, that I did not understand the business well enough, that my circle of competence did not extend to internet companies. Charlie Munger said it more directly than I would. We screwed up. He used stronger language than that, but the meaning was the same. I blew it with Google, and I managed to watch Amazon do something no company in history had done quite the way Bezos did it, and convinced myself I did not understand it well enough to invest. I gave Jeff Bezos a pass. I told myself that what he was building was peculiar, that it defied normal business analysis, that I should stay inside my circle. The circle cost me more than almost any mistake I ever made inside it. The dumbest stock I ever bought, I named my company after it. The most gruesome deal I ever made, I paid for it with the most valuable currency I had. The British supermarket, I dawdled past the point where dawdling was rational. And the ones that haunt me most, I never bought at all. 4 completely different failures, 4 completely different causes. One thing they all have in common, I knew better, not in retrospect, in the moment. When I let Seabury Stanton make me angry enough to buy a textile mill out of spite, I knew that emotion was not investment analysis. When I paid for Dexter Shoe with Berkshire stock instead of cash, I knew the rule against it. When I held Tesco past my own discomfort, I knew what Charlie would have said about dawdling. When I watched Google through Geico's advertising results and decided my circle of competence did not extend to the opportunity in front of me, I knew I was making a choice that I would regret. Here is what I have learned from all of it. And here is why I talk about these investments publicly, despite the genuine discomfort of doing so. The framework does not protect you from yourself. The rules only work if you follow them in the specific moments when following them is hardest, when you are angry, when the deal feels too right to question, when acting requires admitting something you do not want to admit, when the circle you have drawn for yourself is the thing standing between you and the most obvious opportunity of the decade. The mistakes are not failures of analysis. They are failures of self-discipline, of emotional management, of the willingness to follow your own rules in the moments when your own rules are most inconvenient. I talk about them because I think they are more useful than the wins. The wins confirm the framework. The mistakes reveal where the framework stops working and the human being takes over. And the human being, regardless of how many decades they have been investing, regardless of how many shareholder letters they have written about the importance of rationality and discipline and the dangers of emotion, is still capable of buying a shoe company with stock they should never have used, of dawdling through a position that their own analysis told them to exit, of watching the greatest advertising business in history compound from a front row seat and deciding their circle was not big enough to include it. I have made more money than almost anyone in history, and I have made more mistakes than most people realize. The ratio is favorable. The mistakes are real. Every one of them is in the record. Every one of them cost someone something, and every one of them taught me something that no success ever could, because success confirms what you already believe. Mistakes show you where what you believe is not enough.
A company he named after a spite purchase, a shoe company he paid for with stock worth $19 billion today, a British supermarket he dawdled through for a $400 million loss, and Google watched from a front row seat and left on the table, the greatest investor in history, the same mistakes every investor makes, just at a larger scale and with the rare honesty to put them all in writing. Your action this week: pull up the worst position in your portfolio right now, the one you are holding past the point where your own analysis says you should. Ask yourself honestly, are you holding because the thesis is still intact, or are you dawdling? Because if Warren Buffett can lose $444 million to dawdling, it can happen to anyone. If this made Buffett feel more human and his lessons feel more useful, share it with an investor who only ever sees the wins. The losses are where the real education lives, and I'll see you in the next video. Bye.